question number one here is it possible to find positive cash flow properties in today's environment? And if so, how? How do you feel about that one, Grant?
Yes, I feel as though the answer should be nice and easy. The answer is yes. Of course it is.
Moving on.
Next question. No, you included, if so, how? So we'll have to give it more detail. Now, you and I have spoken about this at length because, and actually you've got this great formula that involves 3 different layers to it. So I'm not even going to steal your point. I'm just going to let you dive into it. Charlie, my answer is yes. But what is your answer? And if so, how?
I think when we get this question, I've had it a couple of times now as well, I will mention here, what someone's really asking is like, can I find positive cash flow properties with minimal deposit? That's what they're really asking. So if I have very limited funds, is it still possible to find a cash flow positive property? And then there's like this little sub layer of like, without taking on too much risk.
Yeah, it's like the question of like, why are they looking for that specific thing? And it's like, well, I don't really have any cash reserves and I'm using all my emergency fund to go and invest in property, but I don't want to take any risk, which means it has to work. That's like a 99.99% chance it has to work. And if it doesn't work the way I hope it works and I do need to dip into my pocket, it needs to be nothing because there are other things that I have to pay for. And that's really sort of the undertone of this.
Yeah, so that's I suppose the dangerous part of this question because, for example, there are positive cash flow properties out there today in Australia with a 0% deposit, but they're in like speculative mining towns. So would you really want to own that asset even if it was that way inclined? And I look at those situations and say that's probably the stuff that we have to look at here. The other factor in this scenario here is, well, the one I'll lean into for number one is the size of deposit. So, for example, you could buy a property in, I'll just use Melbourne right now. Let's go with Albert Park, quite a nice suburb of Melbourne.
Great.
I love that suburb. But the point being is that if you went into Albert Park and you were trying to get like a 90% loan, like use a really high amount of leverage, that property would be very negatively geared just due to the yield that's on it. But then on the other side of things, if you went to Albert Park and let's say you've got a $5 million deposit, I mean, you probably own the property outright. So with no loan, of course, it's positively geared. So number one factor that comes into if a property is going to be positive, negative, or neutral comes down to the amount of deposit you have versus the cost of the property. So very important factor. The second part in the equation is the yield you get, right? So again, in Albert Park, you probably get maybe a 3% yield today.
3.5,
maybe,
give or take. Yep.
Yeah, where if you were going to buy a property in, let's say, Perth, I know right now there's some out there that are 5% yield. Yep. So you can see that yield differential just changes the cash flow of the property itself. And then one point that I'll go into further is that there needs to be an acknowledgement of just how different the running costs are in properties. It's not universal either. So something you and I have both been exposed to, and I've got a little ratio I'll talk about here, but it's like the example we've covered on other episodes is Queensland. It's much more expensive to operate a property from like council rates and insurance compared to some other places. Again, I'll just use Perth where it's much lower. So Grant, I know you've got some stories on this. Do you want to unpack a couple just to kind of highlight the individualities?
Yeah, and so I look at it from 3 different layers, which is exactly what you've done. I'm just going to rephrase them. So the first one is what's the revenue that you're getting every single month, which is your rental yield. Awesome. What is the running expenses, excluding debt, of that property, which you've mentioned, like the insurance, the council fees, all those kind of fun things. And then the last one is like the debt, right? Which to your point, it's like, well, if you put a larger deposit on, then obviously it's a lesser amount of debt. Or another vehicle that other people might use is like an offset account where you go and put some money in an offset account. Again, playing with that debt to reduce the amount that you're paying back. And so for myself, I've got places in, to use your example, places in Queensland and places in WA. Now in Queensland, what you can do is you get places that have a higher yield. So I've got some places that are sitting at a 9.5% rental yield, right? But then the expenses on the place are extremely high because of insurance. And so what I've actually had to do is massage out the offset account to make it a cash flow positive property. So in this example here, my income, which is the rent I'm making, is not covering all of the expenses that are going out on the property, including maintenance, right? And so it's negative by about $50 a month. approximately. So if there's no maintenance, Charlie, I'm doing well. There's a little bit of maintenance. It's about 0. And so what I've done is I've merely just adjusted the debt. So I have cash sitting in offset so that the entire thing is producing profits, right? And so that is one of the ways that I've actually utilized cash and offsets in order to produce profits from a property. Where then you go and look at one of the properties that I have in WA, and I was looking at potentially increasing my deposits, which I currently do 20% deposits, to putting a 30% deposit in, which means I've got a less of debt sitting on the property, but it then means that my property payments are lower. So instead of using offset, I just go and put in a larger deposit into it, because that rental yield, I think, was about 5.6%, but then the expenses weren't going to sort of cover it off. And so that is the way that I've actually leveraged the debt component, because I can influence that more than I can influence expenses. I can't go to the government and say, hey, just want to charge me less on council fees, please? Or like I can go and look for a cheaper insurance.
Sure you can.
Yeah, sure you can. But the insurance companies, I can compare it against 100 different insurance companies, but there's none of them are going to charge me $1 a year. There's always going to be a ceiling on that, or a floor, I should say, on that, which means that I can't massage the expenses that much, and I can't ignore maintenance fees, and I can't ignore all these other things, which means I just go back to wherever I can in order to find the best place to massage it. And I will call the elephant in the room out. Obviously, if you're buying in a place that has a lower rental yield, knowing that up front before you actually get in is one of the key elements to this, right? Because nothing would be worse than buying a place in Albert Park, for example, Charlie, and saying, oh, I'm totally going to get a 5% rental yield on this. And then you go, oh, wait a second, I'm only getting a 3%? Oh my gosh, I didn't realize. And then just being surprised by that. And that is more about finding the property that fits your personal scenario, that fits your personal situation, and making sure that it applies to that.
I think you're forgetting a very critical layer to all this.
Let's do it.
You ready for it? So actually, I'll even mention this first. Isn't this one of the best things about property, though, that you can identify this stuff before you go in? So if you're looking at a property, like you can ring the property manager and understand rates, totally. Costs. Like you're not going into it blindly. And I think if anyone as an investor is going to buy a property, I would encourage you explore the expenses before you buy it, not just thinking about the purchase costs. But there's a couple other things that kind of happen with this that I think are really important for consideration. Is number one is that interest rates change. So you can get into a property and it might be positively geared, but if you haven't put in appropriate buffers or you haven't factored in where rates could go, and certainly the evidence of the last few years is you can start out positive and then rates go up, 3%, and now you're negative. Now, so really big important factor if you are someone wanting to do the positive cash flow thing in property is putting in a buffer in that. But the other side of this that I think is the critical layer is like rents historically have gone up. So over time, you might buy a property that is slightly negative or neutral or even slightly positive, but over time, as rents increase, provided you don't increase the debt, you will eventually end up with a positive cash flow property. I won't say in all circumstances, but majority of the time within 10. Now, I know this is something you've experienced as well, Grant, but it's like across the portfolio that I've built, it's like as rents have stacked every year, like some of the properties I bought like 3 or 4 years ago now, like because rents have increased so substantially, that positive cash flow nature is just expanded over time. And that's where the hidden advantage is. Like, I think there needs to be less thinking about what it is on day one and then more thinking about what it could be 3, 5, 10 years from now and play the long game here.
All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.